There's a really, really good story that I heard that I dug out. And when we speak about the power of community, this probably lays a really good foundation for where I want to take this point. And it's the story of the eagle that was raised as a chicken. There was a eagle's nest. One of the eggs fell down and it fell into a chicken coop. The farmer then found what was an eagle, but raised it around the other chickens. So the eagle grew up doing what chickens doing, like clucking and plucking around for food, for example. The farmer knew this was an eagle, but just parading as a chicken. So he called him like what they called a naturalist. And he said, mate, I truly believe this is a chicken. And the guy's like, no, mate, it's an eagle. So the naturalist picks up this eagle, puts it up on his arm and tries to get the eagle to soar, but it just won't. The farmer's like, see, I told you, mate, it's not an eagle. And this naturalist truly believe that this eagle is in the wrong place, in the wrong environment. So one day he takes the eagle out, well outside of view of the farmer, outside his normal environment, the chicken land, takes him up to the bottom of a mountain and puts him out and tells the eagle to go and soar. And at that point, the eagle then takes off, spreads its wings and flies. But what I'm trying to get at is environment plays a huge role in your performance. Mm-hmm. If you're hanging around people that are saying the market's going to crash, if you're hanging around people saying property's overpriced or it's the wrong time to invest, wrong time to buy, you probably need a new peer group. G'day everyone, welcome back to another episode of the Australian Property Investment Podcast. We're kicking off 2025 with an absolute bang. I've got my left and my right hand man with me. I am missing my partner in crime, Bernadette. It's school holidays, so someone is taking care of our two kids, and that responsibility's gone to Bernadette. Damien, how you doing?
Good, mate. How are you?
Awesome, thank you. Nate, how you going?
Yeah, very well. Good to be back in the studio.
Yeah, mate, we're all looking nice and tanned, if I can say so myself. Bit of summertime chance to take stock, relax. To kick us off, something that Bernadette and I have spoken a lot about, and a lot of people have reached out. I think when we did this last year, was speaking about what we call our vision board. You probably would have seen a lot of this on Instagram. It's probably got a lot of traction. Bernie will lay claim to the fact that she was doing this years before it became mainstream. And that probably rubbed off onto myself. And, when I look back on particularly my journey in broking, I go back and look at some of the achievements that I wanted to do in like 2017, 2018. I wrote them out and I still have those lists with me today. And it's amazing that when I look back at them, I achieved them all. And I think a goal written, there's a lot of research around it. I will probably find the research and dig it out. But the fact that when you write your goals, you will have a much higher likelihood of achieving that. And if that's something that's going to help you come into 2025, then this episode, I promise, would deliver on how you go about, one, getting your mindset right, but two, like a goal without a plan is simply a wish. And that's I think the big message that I want to get out to you if you're listening is you can dream it, but you got to be able to do it and execute. And you've heard me say this time and time again, the property market rewards action takers and decision makers. So you can have the best loan strategy sitting in your inbox. You can have the best buyer's agent that you research. You've got to be able to pull the trigger and you've got to be able to find a way to move forward. So let me start off with something that we call our vision board. I'm not sure you can see this. This is still unfinished because Rachel, our designer, will put the finishing touches on this. But this to me talks about everything I want to achieve in 2025. So I've broken this down into probably the key areas in my life. So one is obviously my financial goals, the investments, the savings that I want to make this year as well. Health and well-being is super, super important to me. So, the way I train, how I want to, recover, for example, the personal work that I do. I've got a personal coach, for example, so doubling down on the coaching work, the business success that I want to achieve, the books that I want to read this year, and the adventures and experiences that I want to go through this year. And one of the big ones I'm looking forward to is the Ashes at the end of this year. I definitely want to get up to Brizzy and watch the day-night game. There's stuff that I want to do with the kids, like Bluey's World. That's in there. Yet how priorities have shifted for me. The properties that we want to purchase this year as well. And I think some of the personal work that I want to do too. So if that's something that interests you, I highly recommend Googling a vision board. I think our team will be doing our team strategy day. So I'm looking both of you guys going, if you haven't got the juices going, definitely get some plans mapped out. And
definitely. As your mortgage broker, I'd love to see the property plans so I can put your strategy.
Oh, mate, it's no secret. It's no secret that this year is we're putting the foot down. Absolutely, acquiring, and I think with the commercial property that we've got, I think it's a couple of months away from being completed. So I'm very, very excited about having that released out.
And I do vision boards all the time. Ever since obviously working with you guys. Yeah, it starts small. Like, it doesn't have to be large
Grandiose,
goals. I looked back at one from 2017. It just had a picture of a mattress on there, and I just wanted to get a new mattress.
aim big, fella. Aim.
I ticked it off, and you can see year on year as my goals started to grow and grow and grow. Yeah. And you're right. Some you don't achieve, but the priorities shift a little bit throughout the year maybe. But it's amazing how much of it you do achieve, and I'd probably say you've achieved the majority of what you put into it. So it's definitely a good way of aligning yourself for the year.
Mate, we've done it. So again, if you want to get yourself plugged into this headspace, go back to one of the episodes I did with Keith Abrahams. I've got to tell you, it's probably, again, I might have said it before, one of my most favorite episodes, non-property related. I've had the chance to see Keith speak a number of times, and he talks about that power of goal setting, the power of pulling the trigger, the bucket list of 100 items on your list. Mate, one of my bucket list items was to blood a top 100 broker. And you actually able to help me tick off one of my top 100 lifetime achievement lists because Damien made it to the top 100 brokers for last year, which, mate, kudos to you. Congrats.
Thank you very much.
A huge achievement. And I thought it was something that I wanted to pass on because I'd achieved. I wanted to pass on to someone else. And I'm sure you'll pass the baton on to someone else as well in time. Yeah, so to me, it gives me a chance just to kind of reflect what I want to do this year. And then this will lead into my calendar where I actually start to put it into place. So I want to go train in Thailand again, a Muay Thai camp. I'll put that into place this year, along with the other things that I want to do with my family. So I highly, highly recommend getting yourself a vision board that you can pop up on. That'll go onto our bathroom window. That'll go on my desktop. That'll go on my next to my desk in my office as well. So everywhere I'm looking and seeing it, it's just that power of reinforcement.
Definitely. Yeah. And just on the holidays, it's so important to set your holidays so you don't burn out throughout the year. Because if you're looking to kick goals, you're going to be foot to the floor, working big hours, but you're going to burn out if you don't take time to rest and recharge. Yeah. So we're big on that, right?
We are 100%.
Put your leave in for the year. We all arrange it around each other's days, but making sure you've got that in place so you can work towards breaks. And it creates... it keeps the energy flowing.
And it gives you something to look forward to, right, definitely. As well. Like, that's what keeps you going a lot throughout the day.
Definitely.
Well, I mean, the research says that people actually they spend more time researching their holidays than they do spend buying a home.
Yeah, right.
So, yeah, some research out. Again, I'll try and find this so I can, you don't think I'm talking absolute smack. But this is some of the research that's been done where people spend more time planning out a holiday. And think about it. We're YouTubing, we're spending more time on there versus, they see a property and they go and buy it with very little due diligence. It doesn't surprise me when that type of research comes out. There's a really, really good story that I heard that I dug out. And when we speak about the power of community, this probably lays a really good foundation for where I want to take this point. And it's the story of the eagle that was raised as a chicken. So the story is there was a eagle's nest. One of the eggs fell down and it fell into a chicken coop. The farmer then found what was an eagle, but raised it around the other chickens. So the eagle grew up doing what chickens doing, like, plucking around, clucking and plucking around for food, for example. And the farmer knew this was an eagle, but just parading as a chicken. So he called him like what they called a naturalist. And he said, mate, I truly believe this is a chicken. And the guy's like, no, mate, it's an eagle. And he tried to get the eagle so the naturalist picks up this eagle, puts it up on his arm and tries to get the eagle to soar, but it just won't. And the farmer's like, see, I told you, mate, it's not an eagle. And this naturalist truly, truly believed that this eagle's in the wrong place, in the wrong environment. So one day he takes the eagle out, well outside of view of the farmer, outside his normal environment, the chicken land, takes him up to the bottom of the mountain and puts him out and tells the eagle to go and soar. And at that point, the eagle then takes off, spreads its wings and flies. And I feel like, look, I've condensed that story down into like maybe 30 seconds there, for example. But what I'm trying to get at is environment plays a huge role in your performance. Mm-hmm. If you're hanging around people that are saying the market's going to crash, if you're hanging around saying people are saying, property's overpriced or it's the wrong time to invest, wrong time to buy, you probably need a new peer group. And that's not disrespectful on your friends. They may come from a different place, different headspace. I really feel like I've got a burning desire for people that have been listening to our podcast is to take you into a group that I'm calling the Property Powerhouse. And it's a peer-to-peer group where we can celebrate your success in property. And I've tried this with a few really, really close clients and throughout last year, and we had some really good success where they don't really know each other. They're like, this is a complete stranger, but what they want to do is what I'm aiming to achieve, whether it's buy 2 properties in 2025. We've got some that have got really lofty goals in 2025. And this power of peer-to-peer learning is going to really set your goals on fire and going, hey, mate, have you done what you said you were going to do? I'm part of a men's group where we meet weekly. And we have to show up in a certain, one with certain energy, 2 with certain things done as well. So if that's something that interests you, reach out to us, whether it's through our DMs, whether it's through you've got our email address there as well. Tell us, Property Powerhouse, I'm interested. What I'm thinking the format will be is probably once a month, meet up. I want to be open with you. I'm going to put a fee involved because what you pay for is what you truly value. This is not a drop in, drop out. You articulate your goals, you become highly accountable to the group. And what we're going to do at some point is bring in special guests. I'm talking like some of our highest performing property podcast guests to come in, do a special Q&A. But the most important part is peer-to-peer learning. So if that's something you're interested in, please do reach out. I want to kick that off probably like February or March, get this underway. I can see Rachel behind the camera looking at me because I'm dropping this on her and she'll probably run it for me. But this is what happens. We get an idea, it's execute, it's move fast, let's get things done. But the whole goal is how do we stay accountable to the goals that you have on your vision board, to what's in your mind, put it out there to some others and become truly property powerhouse is what I'm aiming to achieve. Yeah. Which then leads me to our next point, which is feeding your mind. Something that I've done very, very consciously is change my YouTube algorithm. The people that I'm getting on there, it's just giving me so much good content in terms of like feeding my mind, feeding my energy as well. Talking about the Jim Rohns of the world, talking about the Dan Martells of the world, for example. People that I naturally align to. It's not. And I'm telling you have to follow them, but just find someone's going to lift you up, find someone's going to feed you some good information as well, and rewire that algorithm that it's just going to give you more good content after another. Okay, so that's something that I'm going to leave you with some homework to do. The last point before we get into our mortgage myths episode is particularly for those that are in relationships as a couple, something that Bernadette and I have found recently, particularly being around the kids a little bit more, during school holidays, is our time to connect and our time to actually have a chat about what do we want to achieve, whether it's financially, property, life-wise, in 2025. So be able to carve some time out for yourselves as a couple to get some financial alignment. I often say that you can't build a house of 2 different blueprints as a couple. You've got to get on the same page, and typically one person in a relationship is taking the lead from an investing perspective. You have to give your significant other time to come up to where you are, because you spend all this time, listening to podcasts, watching videos, and like I said, you throw it on them, go, I'm going to invest, I'm going to go to this person. They're like, oh, whoa, who is this and what's going on here? And I call it a bit like the handbrake. Don't see them as a handbrake. Just know that they're hours and hours behind of the research that you've done as well. So to me, if you're going on the journey, go on this together. Maybe listen to an episode separately, come back together, have a chat about it. What did you get out of it? What's your perspective? Because people do have their own financial stories. Their parents have gone through different things. Maybe investing didn't work for them. Maybe they've had a relationship in the past where investing didn't work there either. Or you've had a great track record in investing. Now you want them to kind of join you on that journey. So meet them wherever they are is what I'm trying to say here. Let them come on this journey with you, because if you're trying to do it together, you both need to buy into this. And you probably see this, guys, when we're talking to couples, right? Someone is heavily subscribed and the other person is got their L plates on.
Oh, personally, because I'm a broker, my partner who is not a broker.
No, you've done your 10,000-hour rule.
I don't bring work home. Well, I try not to anyway. But when I come up with ideas, she just goes, what are you talking about? But I've been thinking about this day in, day out for years. So I've got to be very mindful of that. Yeah. It's not a handbrake. It's, hey, I need to educate her so she can come up to where we want to be or where I want to be.
And a big mindset there is protection. So they're trying to protect you from making bad or rash decisions. And it's like, it's not a bad thing. See it as maybe, oh, yep, they're coming from a place of love. How do we make sure we get on the same page? Because if you're using their income, then they've got some skin in the game too.
Definitely.
Yeah.
Just a tip on the algorithm. So you've got, I think YouTube, TikTok, you've got following and for you reel. Like, you can scroll on the reels.
Right. Yep.
If you get stuck on the for you, that's when the system's just shooting out what you're hovering over. So that's when you can get quite weird videos or quite unique reels. But if you have like what you're mentioning, you can follow people and then just get the reels just of people you're following. So that could help if you're having trouble, I guess getting your algorithm up to where you want it to be. Follow the people that you want to listen to and make sure you're in the for you section of TikTok. I think YouTube's got a very similar reel and not just the random algorithm that's chucking videos to see if you'll like it or not.
I paid for YouTube Premium.
Oh, yeah.
So I could just turn my phone off, the screen off, and I can still listen to it.
Oh, good one.
Yeah. So again, I was like, how much is my time? And this is no big noting myself. I think everyone should know their hourly rate. I was like, how much is my time worth? YouTube Premium costs, I think, maybe $30 a month. I wouldn't even know. But I'm like, it now allows me to turn my phone off and I can still listen to it without being on the screen. And I think something that we all would have done in the summer break is we would have been off our devices a lot more. If you're struggling with that dopamine that's coming from your device, a book I highly recommend is Stolen Focus. So I think I read it over a year ago. It's one of the best books that talks around, how much we rely on our devices and how much dopamine being fed from, being on the socials. I took a break from socials a long time ago, deleted all the apps of my phone. I haven't reinstalled them. So again, sometimes you got to hard code yourself that, we don't trust ourselves with these apps. I know we're talking about property here, but this, a big part of this is mindset and how you show up as well. And if you can't help yourself, then you got to find ways to get off the socials if it's something that you're struggling with.
Yeah.
Cool. I want to jump in. We are going to break down, call it frequently asked questions, call it mortgage myths. We're going to debunk a few because these are probably things that get a little bit under our bonnet when it comes to people having these preconceived ideas about when it comes to getting a loan. So again, if you know someone that's going to benefit off this, shoot this out to them once you've had a chance to listen to it. So number one is, I have to be off probation to get a loan. Boom, boom. Absolutely not. Now, guys, tell me, we could do a loan on someone being first day on the job.
Correct.
First pay slip.
We could get a loan lodged, conditionally approved with a pay slip to come in.
Yeah.
So off someone starting a job. And let me tell you, these are two of the big four banks that will do first day on the job. Correct. So I don't think we're going to some sketchy lender. So, anytime you're thinking about making a career move, I'd probably suggest no more than 30 days gap between employment. That does open up more lender options for you.
Mm-hmm. But if there is a larger gap, there's still lenders.
There's still lenders.
Do it. Major lenders.
Major banks.
Yeah,
so
major banks will touch you. There's other banks that will touch you as long as you're in the same industry, same role as previous.
Yep.
They don't have problems with that.
Yeah, great.
Yep.
So if someone tells you you have to be off probation to get a loan, one, give them uppercut. Two, tell them they're wrong. And three, then speak to us because you can definitely get a loan while you're on probation.
Definitely.
Yeah. Cool. The next one has to do with borrowing capacity, that I pay my credit card off every month. Therefore, why is it being counted as a liability and doesn't affect my borrowing capacity?
$0 balance.
Yeah.
Right?
Yeah. I don't use it.
Yeah.
Yeah, the bank doesn't care. We've spoken about credit cards being the exact opposite of what we stand for. I continue to get amazed by how many people are obsessed with keeping their credit cards. If it was up to me, I'd take the credit card and I'd cut it up and say, that's it. Do without the credit card because you don't need the points. You need the property. So what's more important, points or property? Make your decision.
And practice what you preach. Aaron, you cut up for your application like 2 weeks ago. Cut up the credit card.
I was like, we had it. It was like a 0%.
It was like an overseas one, right?
Yeah.
Yeah.
I was like, mate, if I go overseas, I need the cash anyway. So cut the credit card up. I didn't even flinch when he said, hey, mate, let's do that. And yeah, that gives me the right to tell someone what to do because I'm going to do it myself.
Correct.
Yeah. So yeah, it doesn't matter if you clear the credit card every month. If you don't even use it, the bank doesn't care. They'll say tomorrow you can go and max out that credit card. So to me, you got two options. One, try and get that limit reduced to its absolute bare bones, or two, get rid of it. Because the irony is you get a loan 2 days later, you can go and apply for a credit card anyway if you absolutely need the crutch that much. So that's one. Credit cards don't impact your borrowing capacity. They absolutely do. So, fellas, give me an idea. If I have a $10,000 credit card, how much does that reduce my borrowing capacity by?
About 50 to 60K.
That's crazy.
5 to 6 times.
Yep.
Generally around that upper side of the 6.
Yep.
It's great. Yeah, 5 to 6 times. Whereas my income is about 4.5 to 5 times
That's right.
in terms of how much I can borrow as a multiple. So we're saying the income you're earning is being offset. You're losing that income by having a credit card.
And what I find is, especially with like the rise of like the influencers, and they talk about the points being such a big thing, I'll get like a young couple come to me. They both have like 2, because normally you get really good points at that 15K mark for the limit. So they'll have each have 2 $15,000 credit cards, so 30,000 each, 60,000 combined. That's like $300,000 of borrowing lost just because you've got 4 credit cards. Yeah. It's insane.
Maybe part of our role is, this platform is to raise awareness. So if you listen to it and you're unaware, awesome, mission accomplished from our perspective. But when you're going through the application and we're coming back to you and saying, hey, look, reduce the credit cards, and there's friction at that point, how bad do you want it? Mm-hmm. How bad do you want it? Because I'm telling people, again, this would be something that comes up throughout this. The theme of this is you can actually buy more home. You increase your income, reduce your expenses, buy more property, buy more home. It does it just, to me, the math ain't mathin' when you have credit cards. One, either you're not using, or you can just simply replace it later in the future.
Correct.
Yeah. Cool. Another one, the number 3, smaller lenders are riskier.
Nate, what do you think?
I don't agree with it.
Yeah.
We've got nothing to, I don't know, there's no track record to say they are, right? Like, what have we experienced?
Yeah, I'd say it probably goes back to maybe the GFC. So well before your time. You're probably in your nappies there, mate. Yeah.
Bit out of line there, but
So what happened was the non-bank lenders or small lenders had to really increase their interest rates because the capital and the requirements, they were small banks, small balance sheets. So they had to increase their rates out of cycle a little bit more and were deemed more expensive. I'd say now, off the back of that, there's the government-backed the deposit scheme, deposit guarantee. So if you check out on APRA's website, they've got all the listings of lenders that are deposit-backed as part of the guarantee. Mm-hmm. But I say to people, I'm like, look, they're lending their money to you. Mm-hmm. They're the ones taking the risk. Yeah. So don't feel like because I haven't heard of this bank before that there's a risk attached to it. Now, there's a difference between risk and rate, though. And I think that's a big part for us to talk about, which is some of the smaller lenders know that they've got better borrowing capacity. So it's a pay-to-play model. So if you want, 200K more borrowing capacity, and they know that they're, non-bank lender, the living expenses differentiate a little bit more and they give better borrowing capacity. If you need more lending to go and buy another property, then you're just paying a slightly higher rate. Not the end of the world.
Yeah, that's right. The rate gets higher as the loan gets riskier for the lender. Yeah. Yeah, and they'll take a risk on borrowing. Like some non-banks will increase your borrowing into certain policy. Yeah. They might take a risk on the security. They might take a risk on your income if you're like self-employed, for example. So that's how it's all factored in. So it's not riskier, but you can get riskier products. Yeah. You'll just pay a higher rate.
There we go.
And at the end of the day, if you are so averse to these products or these lenders, I think our ethos is like, do what you got to do to get the property. Yeah. If you're so against this lender, refinance down the line. Right?
Yeah. Use it as a tool to get in.
That's right.
Yeah. And just remember, you're not buying a loan. Think about it. You're buying a home. You're buying property. So the loan you can interchange any time. Mm-hmm. Tom Panel says it great. You marry the home and you date the rate. Perfect saying.
Yeah.
Yeah. It's like you're leasing the loan. You can literally just chop and change it at some point in the future. Yeah. So get past the fact that you're not buying a finance loan. You're buying a physical property that's attached to it. So hopefully I can shift your perspective around that as well. The next one's an absolute winner. Time and time again, this comes up. The one either is LMI is a waste of money, or 2, you need a 20% deposit. Mm-hmm. Discuss.
20% deposit. Well, that's a lie.
It's such a redundant philosophy.
Was it ever a thing?
I mean, Barefoot Investor peddled that crap a while ago.
Yeah, but the bank surely didn't what, in the 50s? When did
Yeah.
you require?
How do we parents?
deposit?
I mean, some parents say, "Oh, you absolutely need it." Some people have come back to us saying, "Oh, I need a 20% deposit." I call BS on this. I think somewhere maybe 10% is a real sweet spot to get into the market. You should be getting in with a minimum deposit. Buy what you can, when you can, where you can. Get into the market when you're absolutely ready and possible. That's simple. I feel like that's the advice there. Advice aside, when we go to unpack this mortgage myth, you don't need a 20% deposit. Absolutely not. LMI is not a waste of money. LMI is an enabler. And when I've done all the maths, so listen to my episode I did with Strawn from Helia. I would have done something else in the past where we talk about mortgage insurance. Jay, that episode as well, in terms of how much the property market increases on average. Mm-hmm. On average, the property market in Australia, median house price does about $1,000 a week. So if you can't save that, which very few households when you're renting can afford to save an extra $1,000, and the property market is outpacing your ability to save, LMI is 2%, right? Generally, rule of thumb. Sometimes by the time we've got to like an extended settlement, people actually made back in capital growth, believe it or not. Yeah. So don't see LMI as a waste of money is where I'm really trying to get to. And Nathan, you helped me on this one actually, which was when people say, hang on, but when I don't have a 20% deposit, the interest rate's much higher. Yeah. We've got a kind of a little hack around that.
Yeah, so I guess the variable rate, will be a bit higher. So what have we got there? So for owner-occupied P&I rate, 90% LVR, 6.4 to 6.7, around that. Yeah. With the current way rates are predicted to move, fixed rates are slightly lower than variable at the moment, or the 1 and 2 year fixed. So the 1 year fixed, for example, 6.1 to 6.3%. Mm-hmm. For the same product.
So if I look at, and I'll give you some context. So you bought a property, say at 90% loan to value ratio because you had a 10% deposit thereabouts. What we could do is, instead of being variable, you could fix it and you'd get a lower rate. Now think about it. You're not having a huge amount in your offset account because you've used pretty much all your cash to get in there.
Yeah, correct.
And in 1 year, we're probably not going to be able to refinance that property typically because you bought it at 90%. So the security of a fixed rate just goes, look, I know exactly what my next 12 months is going to be like from a repayment perspective. We could then revisit it after 12 months' time, but it means you've kind of locked in a lower rate. And if you're sitting here going, but hang on, 6.4 to 6.7, and it's 0.3% difference, what happens if the RBA cuts twice? Well, how long is it going to take for the RBA to cut? The banks will reduce that rate in about a month's time after the RBA. Mm-hmm. So you've got to wait another month lag. Don't overcomplicate it. Just go right now. We could get in. We know what the rate's going to be. We can manage our cash flow as a household, and it just gives you that security and stability by having a fixed rate. Typically, I don't love fixed rates, but I think in these horses for courses, this could be a very good solution as well.
Yeah, but I think above 90%, it really makes sense.
Right?
Yeah, and look, it's only certain lenders. Some lenders do price fixed rates based on LVRs.
Yep.
But most of the big banks will price fixed rates all the same, regardless of the LVR.
Yeah. So again, having a chat with your broker and just going, is this something that we can consider?
Yep.
Again, if we're raising the kind of bar on the conversations we're having, we're not just buying a loan on rate, we're buying a loan on outcome or solution. Okay.
Can I just jump in and just on the LMIs, back on the LMI as a waste of money?
Yeah.
I think a way to look at it is LMI, right? For about a 550K property, if you're using a 12% deposit, LMI will be around 8K. Mm-hmm. I think that works out. Don't quote me on the numbers, but regardless, $50-$60 a month extra because you're not paying the LMI up front. You're not paying 8K out of pocket. Mm-hmm. You're paying it over 30 years. So it's like $50-$60 a month. What did you say? Houses go up on average a grand
a week. Yeah. It's absorbed.
4K for a month. Mm-hmm. Yeah. You're paying an extra 60K. Like it's like,
well said.
Why would you not do it?
Well said. Yeah. So if you kind of zoom out a little bit and going, from a loan perspective, it's pushed over a 30-year period. It's absorbed in a monthly repayment.
Refinance in 6 months' time back to 80% when your property goes up by whatever percent.
Yeah.
You stop paying the LMI. It's just a short-term pain, right?
I think this is a older generation problem because younger people are just making peace with it.
I feel like
it's like we're not going to have 20%. They do. It'll save you 40 years to save 20. That's what you hear it everywhere, right?
Yeah.
People are like, I want to get in the market.
Mate, correct. All these rubbish articles like how long it's going to take someone to save a 20% deposit.
Yeah.
It'll take you 20 years.
20 years.
Mate, 20 years.
$2 million on a $2 million purchase price. Yeah, of course it's going to take you that long. Like it's obviously the media getting headlines, but I just think with LMI, younger people are just making peace with it.
Absolutely.
You can avoid it with parental guarantors or government guarantees, but if you can't, so be it. It gets you in the market. It's a tool.
Mate, that's exactly it. It's exactly it. And I would have said this before. Even some brokers say it. And we've said, mate, if you ever hear a broker say you need a 20% deposit, I wouldn't even reply to the email. I'd go and find a new broker. Yeah. Harsh, but true, mate. And we'll do an unpack, I reckon, on because I sat down with Helia, one of the big mortgage insurers, and they put out a massive sentiment report. And part of their challenge is actually shifting brokers' attitudes around LMI. So even within our own industry, we've got people that are anti-LMI. So you can imagine what a borrower is going to get when their broker's projecting that type of nonsense onto them as well. Cool. So number 5, banks will forensically go through my bank statements.
Some banks still will. The majority will not.
Cool.
Yep.
I agree. Until you get to, I mean, that's for the majority. Some banks still will, unless you get to that LVR restriction, right? So if you go to 90, you're paying LMI, some will have more requirements for their submission.
Yeah.
But as a general rule, we will collect them for compliance purposes and we'll scan them, make sure everything in there is kosher.
Yeah.
Otherwise, the banks aren't going through them.
No. Look, the banks are looking at, do you have any undisclosed liabilities?
That's exactly it.
And is your employer actually paying your salary?
Spot on.
And going onto your point now, yes, when the LVR goes above 80 and you're paying LMI, and we spoke about it as well, it's a riskier product. So the bank will do extra verification. Yep. But yeah, that's pretty much it.
Yeah.
Like if they do extra verification, they just want to make sure that what you've declared as spending potentially is going to be in line. But the majority of most of the time, they're just looking for, hey, is there a credit card you haven't disclosed, a personal loan, or are you telling the truth about your salary? Like, is it getting actually put into your account?
Mate, if you were lending someone $1 million, you'd be doing your due diligence.
Correct.
If I was lending my money to someone, so just think about it through that lens. The bank is lending their money to you. They're making sure that what you're giving them is correct. Look, our industry, even if you go through a branch network, there are some bad apples that ruin it for the rest of everyone else. So if you liar loans, for example, some banks have really good checks and balances in place from a compliance or a fraud mechanism as well. But like Damien said, they're pretty much looking for, is there any undisclosed debt? If the bank then sniffs out something, they may ask for something more. And generally we're a filter to go, look, they're just ticking boxes. Sometimes a client randomly gets, an audit as well, purely just because they're testing the bank's own internal measures as well. So
what I will say, one thing is, if you bank with, like, say you do all your banking with a specific bank and you go get a home loan from them, they have to look through all of your statements that you hold with them. So that's when you can get caught out a little bit to say, oh, actually, why have they gone through everything for the last 6 to 12 months? Well, it's because they can see it.
They see all your spending.
And legally, they have to check it.
Yeah.
So sometimes it's best to go to a lender where you don't do all of your spending, just to avoid that extra bit of paperwork that you might have to go through, clarifying all your expenses that come in and out of your accounts. Just a little tip. I find that the loyalty tax is there on policy as well.
Mate, you've literally a mind reader, because the next point here I've got is number 6. But I've done all my banking with them all my life. I should be getting a loyalty discount. They should value my business. I'm like, oh, right, because you're one out of like how many million customers they've got.
Definitely. It's like the opposite. Like you get a more forensic serviceability check because they're looking at all your statements. And then there is no loyalty tax.
There's mate, because you had a Dolomites account with CBA and you go to get a loan with them 20 years later, I'm sorry, they don't owe you anything.
What are the metrics for pricing? Loan, an LVR, and then the product. So
exactly to what Damien's saying is, how does a bank price up a loan? So they'll look at the loan amount. So some have what they call tiers. So if you borrow 500 to 750, $1 million plus, $2 million plus, the bank then offers discounts based on how much you're borrowing. Some banks will go under 70%, under 80%, for example, they'll do tiered or lower rates based on the loan to value ratio. Some will do a combination. Some will do what they call total aggregate lending as well. If you've got other products or you're private or premier banking with a particular lender, they can do some discretion there. So yes, there are ways to get better, sharper, lower rates or pricing with particular banks, but don't think loyalty is the lever to pull to go, but they owe me because the banks don't owe you diddly when it comes to getting a lower rate. I'm sorry.
If anything, no. And let's talk about like the loyalty tax people actually pay. If you stay with that bank once you get that original home loan, one, they don't contact you to lower your rate. You have to do that yourself.
Totally.
They will leave you on the highest rate possible to make the most amount of money out of you.
Yeah.
Like what do? We do 12-month reviews, always checking in to see if they can lower rates. How many times do some of those larger lenders just leave their customers on the higher rates knowing that certain customers just won't go because they've been there for so long?
Correct.
Oh, it's too much effort to change banks. I'll just stay on that 0.2, 0.3% higher rate. Life of the loan, that's so much money.
That, and I feel like I'll elaborate on Damien's point there. So we've got our team that work in what we call post-settlements. That's reviewing clients' loans every 6 or 12 months. So some banks will let us review a loan every 6 months. Some banks will majority do it on a 12-month basis where we review your rate. I think since we've been doing this for the last few years, we've probably put about $2.5 million back into our clients' bank accounts. And I'm really, really proud of this. Again, we're not blowing any smoke for what we do. There's plenty of brokers that do it, but there's plenty of brokers that don't, which is actively reviewing a client's loan. And I think it just came out from, like I said, what would I want my broker to do? This loan's under your management. I don't want to call a bank. That's what your broker is there for. We can go into this online system, put in this client's loan account, ask for a discount, and then we can kind of quantify those savings. And that's over a 1-year period that we've kind of been saving that money. So think about $2.5 million has gone back into our clients' bank accounts since we've been doing this last few years. That's crazy when I think about how much value we're putting back into the Australian economy, and that has not gone to banks, that has gone into their bank accounts. It's crazy. But that's what sometimes we'll have to tell a client, look, you've got to call, because from a privacy perspective, the banks will only talk to a client when they offer the rate. So I don't want clients to be calling, but sometimes it's the only way to get it done. When you have to call a discharge or retention team to say, but look, we need a lower rate. It could be the best 20 minutes you spend out of your day to get, a grand or two back a year. So if you, again, don't be lazy, don't pay the loyalty game. Sometimes you got to kind of be proactive as well to get that money back from your bank. Cool. Point 7 is all lenders have the same borrowing capacity. The kind of thing that comes to me to mind is that super ad, which is like same incomes, same everything, and like different outcomes. We can put the same incomes in and get wildly different borrowing capacities. Elaborate, guys.
Well, yeah, just to shut down the myth, at the end of the day, if that was true, we just show you who's got the sharpest rate. We wouldn't be showing you non-bank lenders with rates of 7%, right?
Yeah.
Where you're saying, we can put the same income in and get wildly different results, that particularly comes into play when you've got a lot of investment debt, with the way the banks calculate negative gearing, and also what you mentioned before, their assessed living expenses of everyone. Yeah. But when we're getting into that where you've got multiple investment properties, wildly different majors.
Correct.
Some will allow you to borrow zero, whereas the non-banks, you can borrow sometimes millions.
Yeah. And then the way that not all lenders are created equally is because some will then add, private health insurance as a part of living expenses. Some that's adding strata as part of, if you've got strata properties, that's an extra expense. The rental income shading varies from 20 to 10, sometimes more as well. So again, these little nuances that I guess that's our zone of genius when it comes to us, is to go, right, these are the numbers, plug it in and go, right, we're getting different results and presenting those results back to someone as well.
Yeah, definitely. Like even if you talk about like a first home buyer looking at like comparing the big 4 banks, they're going to be different. Living expenses is a big one. Yeah. How they calculate living expenses differs depending on the bank. How you calculate bonus, overtime, allowances, depending on where you work. You might be like a police officer. Some banks will take 100% of your overtime. Like that's more income going into the calculating, meaning you can service more money.
Yeah.
So little things like that, again, we know it all. Just come to us and we'll tell you what you can do.
Damien's famous words, we know it all.
Yeah, we know it. But yeah, so they're definitely not created equally. And like Nate said, if they were, you wouldn't have to come to a broker.
No, well said. Number 8, which I think is probably one of my favorite ones, which is the amount of times I hear it's hard to get a loan if you're self-employed.
Yeah, sometimes. But no.
I hate the word hard to me. When someone says it, it's not hard. It takes a little bit more time to a lot more documentation. Now, I'll give you an example. Banks have become a lot more favorable towards self-employed. Let's take a policy where if you're paying yourself a consistent salary, the banks will take that salary over a 6-month period, and you're deemed effectively like PAYG. So we don't need the financials. We don't need to provide a whole heap of like documents. It's effectively the pay slips that we're going, right, if you're paying yourself 200 grand as someone self-employed, the bank will take that 200K income.
They'll generally want to see the income statement as well, again, to make sure you're paying yourself that wage because, someone
verification.
Not doing do this, just generate pay slips for themselves, right?
Yeah.
They're going to want to see salary credits or an income statement as well, just to verify.
So again, if you're self-employed, it's worth having a chat, particularly for someone that's newly self-employed.
Definitely. And I've been thinking about why they're getting so creative with their self-employed policies. And this isn't like the non-banks doing low
These
docs.
are majors.
These are major banks creating these policies to capture more self-employed borrowers. I think it's the rise of the contractor. So many people are shifting to being from PAYG to being like contractors through ABNs, but working for the same company. That's just like blowing up. Obviously, IT led the way, like as that being the model for employment. But I just see it getting more and more pronounced throughout different industries. So the rise of the contractor, I think banks are trying to capture those borrowers in a better way. So you've got like lenders that have no ABN requirements, just one lodged tax return. Generally speaking, the tax return is how you verify your income if you're self-employed, pay slips with some lenders, but it's that verification time frame with the tax returns that's when it gets interesting, because some banks will need 2 years and they'll use the average or the most recent if it's lower. Some banks will just need 1 year.
Yeah.
Which means if you're a startup, the first year you earn nothing, the second year you've got a lot of profit, well, you want to be using that profit. So go to a lender that has that policy who just looks at that most recent year and off you go.
Love it. I love it. I think a big part that comes into play here is probably your relationship with your accountant. Not probably, definitely. I think if your relationship with your accountant is based on how much tax can you save me or how much can I minimize my income to pay less tax, I don't know if you've got the right accountant.
If you're what I find is people, because we do a lot of estimates these days.
Yeah.
Like, do you have an accountant? Oh yeah, he just does my tax.
Yeah.
That's what I hear back, even from people who are business owners. Your accountant should be there supporting the business throughout the whole year.
100%.
Effective tax strategy, but also business planning with you as well.
Correct. Like that I think is the game changer for a lot of people that are self-employed, is their relationship with their accountant. It's like playing the game of, I don't know, football or soccer or whatever you've got, and not looking at the scoreboard. Like that to me is how serious I take our financials, right?
Yeah, fair enough.
You're flying blind. It's like trying to drive on a destination.
No KPIs, no targets.
What's our profitability like? How much tax do I need to provision for based on that profit, right? Expenses, like the accountant, it's like us. We get to see how many investors' portfolios, and we can make decisions off the back of that going, I know where they want to get to. We can structure the loan this way, for example, and it's a bit more proactive in that sense. We're under the pump. So, timing-wise, we're probably blowing out our personal time frame sometimes can blow out. But the amount of times I hear back from people, I haven't heard from my accountant for 2 weeks. I'm like, mate, I don't know. You've got to set a standard that you're going, hey, what's the relationship going to look like for your accountant? And what do you expect out of that? Because if you're going there simply just to clock in, clock out from a tax perspective, I'm going to put it out there. I don't think that relationship is going to serve you well enough if you're self-employed to actually move the needle on, one, either getting more income, two, reducing your expenses, three, eking out more profitability.
If there's an accountant listening, I think if you can create a model where you're on time, you will make a lot of it. So many people that I speak to, they're like, oh, I don't know where my tax returns are up to, or my accountant hasn't responded. Yeah. It seems to be the norm for that industry. So if you have a good accountant who's responsive, is helping you with business planning, I mean, stay with them. That sounds like a really good person. But yeah, generally speaking, the industry needs a bit of a shake-up, I think.
I agree. Number 9 is I'm too young or too old to get a loan.
Well, young,
yeah, there is a restriction.
There is a restriction. 18.
We've done loans for 18-year-olds.
Correct.
We've done loans for 18-year-olds.
You can be 18, you can get a loan.
Yeah.
Old, the bank cannot discriminate on age.
The amount of times we hear this, we hear this going, oh, look, I'm too old. Like, mate, I think I've had someone in their 60s, 68, first-time buyer.
I got a great one last year, 2024. 70, I want to say 72.
Yeah.
Owner-occupied purchase, 60% LVR.
Crazy.
Yeah. She was still working. She had a part pension from another role as well. The exit. So what do we need to show? Because the bank is going to say, and you get it over a 30-year loan term.
Yeah, so the bank's not expecting someone to work at, 102?
Yeah, so a 72-year-old getting a 30-year loan term, and you go, how can that happen? Well, there's an exit strategy out of the loan when that person does reach retirement, for example.
Yeah.
So it's all about how you can exit that loan. It doesn't have to be at the end of the 30 years. It can be brought forward. It could be 2 years. It could be 1 year. You might just want to have the opportunity to buy a property, hold it for 12 months, have the growth of the market, increase your retirement funds, and then sell it.
Yeah.
The bank can't discriminate against the purpose or how you use it or you as a person. You just need to show them you can get out of this facility. And
I think that's probably the part that comes into it where again, we say it's on a level playing field when it comes to knowledge or policy or the broker that you go to. Some brokers will just send that loan to the incorrect bank, get a decline, and that person's now feeling like, I can't get a loan. And that then usually circulates or permeates throughout that community as well, going, you can't get a loan if you're a certain age. Absolutely not. We've got major banks that do not have age restrictions. What they just need is they need some context around how's this person going to either clear the loan, pay the loan down, sell the property. They got savings, they got shares, for example. Give the bank the story that's going to give them the peace of mind to lend this money. Pretty cool with it afterwards.
Definitely.
So, it's what we would call an exit strategy, but that's where we need probably the assets and liabilities, like the full picture, to give that bank, the credit manager, some type of reassurances around how this is going to be closed or paid out. The other one, when we're talking about the other end of the spectrum, someone too young, typically what happens is when you're younger, you're probably in casual roles. So then it's a matter of like the casual income. Again, not all lenders are created equally when it comes to casual income. So knowing which banks to go to that are actually the right lenders from a casual income perspective. I know, Nate, you've probably got a couple of these where they've got like 6 roles, casual incomes.
6 roles.
Yeah. And it's,
honestly, around that. One person. Yeah. 6 roles.
Juggling different roles.
Far out.
Yeah. But we can get it done.
Yeah, we can.
Yeah.
You can get done.
And so, again, it's just finding the right lender. So at this stage, rate doesn't matter. The name of the bank doesn't matter. I mean, that is a major lender that you've gone to, but we're looking for the outcome.
That's right. And like, again, you mentioned you're likely on casual roles. You're probably also on lower income, right?
Oh, absolutely. You might be living at home.
Yeah.
Lower incomes, low deposits. Yeah.
So, yeah, it's not that the bank discriminates against you because of your age. You just might not meet the requirements at that time.
Yeah.
Especially in this rate environment, right, where we're timesing by 4.5 your income when we used to times by what?
7s to 8s.
Yeah.
Cool. 10 is that it's cheaper to rent than it is to own.
In the short term, yes, definitely.
Yeah.
Yeah, in the short term, like I did the numbers on my own personal property.
Yep.
I don't know. Yeah, when I worked out how much interest I paid for the last 12 months and then worked out how much rent I would have paid, it was nearly on par. But then I've got strata expenses, rates, water, those types of expenses that would have
every weekend going to Bunnings.
Yeah, that's right. That tipped me into the negative for the first year of owning the property compared to renting. The difference is my repayments and interest expense, depending on what the RBA does, remains relatively the same. My rent will continue to go up.
Well said.
So there will be a period in time where it isn't cheaper to rent. It would have been cheaper to get that mortgage. So long term, if you're thinking long term, it's always going to be better to own your home. And you got to think, once you're retired, do you really want a big chunk of your retirement to be coming out of your pension, for example, from your super to go to rent?
Yeah.
And the thing also there, if I can, I think you've mentioned on the podcast before, you did use a guarantor loan, right?
Correct.
So you borrowed more than 100%.
Mm-hmm.
So if someone's borrowing only 80%, it's going to be even cheaper, right?
That's correct. Yeah, that's right.
So,
yeah. And so it all depends on purchase price, what you would have paid in rent. But in the long term, definitely, I think owning your own home is cheaper.
Look, it's such a black and white conversation when you go, it's cheaper to rent than it is to own. This conversation has shades of grey from my perspective, because you could go in there and you could paint, you could do flooring, you could do a kitchen or bathroom reno, and you've increased the value of that asset. Mm-hmm. One, I think two, the safety and security and stability that comes with owning your own home. I know it's a journey that everyone goes on to get to point one. You can get a deposit, two, you can get a loan. I think once you get to the point that you can attain home ownership, it's a game changer, because now you've got equity to go and buy either investment property, upgrade your home, sell it capital gains free, for example. Mm-hmm. I feel like they're the shades of grey that almost outweigh the black and white conversation on a spreadsheet going, it's cheaper to rent than it is to own. And I can say that having rented in the past versus owning the worst house on the best street or whatever, it doesn't even matter. Owning a home, to me, I think will always outweigh that ability. That's always a conversation that happens for people that have crossed over into ownership versus, unfortunately being stuck renting. You got to try and get out of that rent cycle if your plan is to own as quickly as possible.
I think if you talk about is it cheaper to rent vest or to own?
There we go.
It's definitely cheaper to rent vest because one, you get deductions back every year. Your interest is deductible. You're earning rental income that's going up in value each year, as is your rental expense. So it's generally cancelling each other out, the increase in rent. So rent vesting is definitely cheaper, but it comes with, I guess, no security because you're renting.
Yeah.
Right? So we talk about this all the time. If you want security, children's normally the big anchor.
100%.
I need to be in this postcode, or they've gone to school here. We need to stay where they currently are. Their friends are here. We've got a community here that normally is the handbrake for people. But rent vesting is cheaper.
Rent vesting on no doubt makes sense.
Yeah.
But I feel like it's one of those crossroads that you go down. Your path of your point of no return, because you've used a good amount of your savings possibly to buy that one or first or second investment property. Mm-hmm. Your savings is depleted. Borrowing capacity probably drops a little bit to buy, the home that you want as well. So again, it's laying out that property strategy. You go, what do we actually want to achieve as a family? It goes back to my very early point going, as a couple, how do we get on the same page? Alignment, financial blueprint as a couple. You can't build a house off two different floor plans. You can't build a financial future off two different blueprints either.
Definitely. If I had my time again, in my 20s, rent vest.
Yes.
I just rented. There's no vesting. So in my 20s, rent vest. And if you and your partner do the same thing, then you get to your 30s when you probably want to buy your own home. You can sell off assets to go and buy, get that borrowing back, get that deposit back.
Yeah.
Rent vest in your 20s, maybe secure your home in your 30s, get back into the investment cycle after. I think that is a pretty good way that the millennials, they talk about Gen Z having a hard time in the market now, can get around that home ownership troubles. You've got to be a bit more proactive in your 20s.
Correct.
Yeah. Or your early 30s, whatever it is. Whenever you start is the best time. Just start. You've literally stolen one of the big thoughts that came to me during the break was to do a video. It was effectively going through these time periods, going in your 20s, you may be single, maybe in a relationship, but that's the time you could rent vest. And then you get to 30s, even to your mid-30s, because you look at the average first home buyer age, it's about 36, 37. So you'll get to that point. You can then see you've had maybe 10 years in the market with maybe a couple of investment properties, sell those down, accelerate your ability to get a deposit to then go and buy the home that you want at 35, 36, for example. Possibly where you want to live at that point. And then you can then, I think, because then you start to see the profile of the investor, it's 40-something. So now I've got equity in my own home. I can then got income, go put my foot down to go and acquire investment properties without risking too much, knowing that one, I've got the stability of my home.
two have got a pretty decent super balance to go and buy, probably either through an SMSF or individually. And then it's like, I'm not risking the house, but now I've got the security for my family as well, because you're thinking maybe family planning kind of in your 30s too. So it can follow a pattern, not that it's a rinse and repeat model for everyone, because everyone's situation is slightly unique, but it has some commonalities to it over certain time periods as well.
I think it will become a more common trend that people have to follow. Like, what was the trend before? Save for your deposit, buy your home.
Yeah.
And now we know that, you can't save as fast as the market.
You can't save as fast as the market, but your savings diminish over time because of inflation. Like you're getting very little on the returns by putting it into a savings account. So you got to think that time value is dropping. Yeah.
Yep.
The last one that I've got is it's a bonus. I know I'll give you 10. I'll make it 11 just to make it worth your while. Technology has made it easier to get a loan. Absolutely not the case. It's kind of an irony that we speak so much about AI these days. Let me just tell you, getting a loan is still a very, very manual, arduous process. I'd like to think that technology should have made the loan application process a bit easier. I'm telling you now, it's not the case. There's still a person inside a bank that looks at every single application. Now, I may eat my words at some point on this in the future with technology advancements, but I'm going to tell you right now, you guys know it. Like some banks are still sitting at like 10 business days to pick up a loan application. So with all the advancements that we've got in AI, we were speaking about Amazon before, like if Amazon ever got into home loans, we'd be out of a job. That's for sure. But yeah, I constantly get surprised about how much manual data entry there is, how much rework that's involved in a loan still in 2025 when I look at other parts of technology coming in and just completely being a game changer.
What has improved? I mean, we're pretty much like a paperless office nowadays.
Yeah.
Remember, like back in the day, we said the
sign application forms.
App forms, all printed, wet signed. Some still do.
Yeah.
DocuSign's a game changer. The Pexel workspace is a game changer for settlement. I find from like formal approval to settlement, it's a lot easier. You just click through, sign your docs, off you go.
Yeah.
That credit assessment process and even
to get to formal approval is still quite.
Because what's there? It's the human interaction that's there. Like it's that credit assessor. And there are banks that are sort of shifting towards having the automatic credit assessment. But what do we find? There's no nuance. You get declined, it's all over. You have to go to a different bank. There's no one to speak to talk about why someone missed a late repayment on X date or why this didn't happen or why a mistake was made, for example. Like it's really hard because it's just black and white when it's just the automatic credit assessment. So while I guess they're shifting towards, I think some banks are trying to put in these sort of like the easier deals.
Yeah.
It's not seamless. And I doubt it will be seamless for a long, long time. Like you work with ChatGPT and it's what you put into it to get out, and even then it's pretty clunky.
Yeah, agreed. I mean, that's 2025 still surprises all of us about how manual, when people go, hey, mate, why has it been 5 days and the bank hasn't picked it up? One, it's obviously there's a huge amount of volume, but two, it's still a human process, right?
Yeah, and that's right. And we've got the automated pre-approvals these days as well, which they're just pre-approving based on what we enter into the system. And it's like, whether you assess it now, someone's still got to pick it up manually when you get a contract of sale.
Yeah.
So, like, it's not really achieving anything. It's just delaying that process as well.
That lender that had the automatic pre-approvals, but it still took 5 business days.
So the technology is great. There should be an automated thing and still taking you 5 days. So we're not ragging on in lenders. This is purely an observation. But to me, that's 10 plus the 1. There's 11 frequently asked questions that we get from all sorts of emails, calls from clients. I do want to open it up and say, look, if you're sitting on some questions or some thoughts that you'd love answered in future episodes, please let us know, because if you're thinking it, probably someone else is. Sometimes we get a little bit too close to the action because we do this on a day-to-day basis. So sometimes it's a little bit hard for us to see all the questions or hear all the questions because I think it just flies off our emails and we go, right, that's just another question answered. So to me, if you have any questions, any burning questions that you've got, we'd love to answer those in future episodes. Also, if you're either building a portfolio or you've got a decent portfolio and you want to share your story or journey with someone else that may inspire the next property investor to take some action, we'd love to have a feature. Some of your clients have reached out going, oh, they're a little bit shy, but they want to share their story. So if you're content to share your story or your journey, it doesn't have to be perfect. It just means that you've taken action. We'd love to do a Q&A as well, because that's something I'm really keen to do in 2025 as well. So that's a wrap for another episode of the Australian Property Investment Podcast. Really appreciate you tuning in. If you know someone that's struggling with these mortgage frequently asked questions, share the episode and let's make some major things happen in 2025.